Good afternoon, and welcome to the latest Expert Series webinar. Today's presentation is The Power of Active in Passive. This is a complimentary IndexUniverse webinar, courtesy of the Vanguard Group. I'm Ollie Ludwig, the managing editor of IndexUniverse.com. We are the public face of IndexUniverse LLC, the leading authority on news and data about ETFs, and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today are Joel Dixon and Jim Rowley of Vanguard. Joel is a senior investment strategist and a principal in Vanguard's investment strategy group. He analyzes trends and developments in the ETF market. Jim Rowley is also a senior investment strategist at Vanguard, and he does similar things as Joel in analyzing trends in the marketplace. A bit of housekeeping before we get started. I may chime in with a few questions along the way, but everyone, please feel free to note that there will be a Q&A at the end that I will moderate. All of you can ask questions at any time during the webinar in the window at the lower right of your screens. Also, bear in mind that the presentation will be available to all of you 24 to 48 hours following today's webinar. I have to confess that when I was first starting to prepare for today's webinar, I was asking myself what has gotten into the water supply in Valley Forge, Pennsylvania, where Vanguard is based. After all, I was trying to digest the fact that Vanguard is prepared to talk at length about how index ETFs can be used to generate alpha. I'll say it again, a discussion on the use of index ETFs to pursue above market returns, and this is coming from a fund company known largely, but not exclusively, for its lineup of passive index funds. But to be completely serious, the fact is that while ETFs can certainly be used like the index funds Vanguard became famous for a generation ago, ETFs are different than mutual funds. Their liquidity and tradability make them different in important ways. And the simple fact is, investors are using ETFs to generate alpha. Just pour over a 13F filing from a hedge fund and notice the big and growing role ETFs are playing in that world. And the rapidly growing realm of ETF strategists constitutes major writing on the wall for the ETF industry. They call their top-down asset allocation alpha through beta or beta plus or some catchy phrase. But it seems that, like BlackRock's chairman Larry Fink has said, beta is the new alpha. So how does the world's biggest mutual fund with $2.2 trillion in assets, mostly in passive investments, end up talking about the power of active in passive? Well, Vanguard is the world's third biggest ETF sponsor, and it is no stranger to active management. That means we have the privilege this afternoon of hearing Vanguard's unique take on what is undoubtedly one of the most important aspects of ETF use from Joel Dixon and Jim Rowley. Joel, you want to kick it off?
Yes, thank you, Ollie, and thanks for all those attending today. I can certainly understand a little bit, Ollie, your double take in when we were first talking about this agenda and this approach. But I think it's important to frame that one of the things that has happened with ETFs is that there has been this evolution of active management and how people go about trying to add value or control risk and so forth. And what ETFs and even index-based mutual funds to a certain extent have been able to do is change the discussion and really bring into the debate or into the construction methodology the use of broadly diversified or potentially even somewhat narrow passive commingled vehicles to express active views. And Ollie, as you said in your intro, we're seeing this in a number of different ways, whether it's the discussion of rep as PM or the role and rising and increasing role of ETF strategists. We've also seen it in other ways in terms of how people are talking about the exposures that they're taking in portfolios. When we talk with advisors around the country and frankly around the globe, more and more there's a discussion about what factors, what risk factors am I being exposed to, and are those the factors that in fact I do want in terms of my implementation. So we've really in many ways expanded the discussion of active from what might have been building portfolios of individual securities, or traditional active management through the selection of mutual funds, traditional actively managed mutual funds where the commingled individual security selection approach may be used. And so this whole array of ETFs have brought a whole host of new options and approaches that could be used to implement strategic or tactical long-term or short-term views in targeted ways. And that's really how we want to talk about thinking about providing those exposures for you as an advisor, an investor may have specific views that you want to target, and how you might think about going about doing that, and the options and trade-offs that may be available from an ETF standpoint. So with that as background, the agenda that we sort of want to go through here is sort of framing a little bit more the active and passive distinction, but also how, in many ways, if you think about it from a sort of Jerry Seinfeld approach, how the worlds have been colliding over the last decade, especially with the rise of ETFs. And then I'm going to turn it over to Jim to talk about a couple of examples about how this might be implemented, whether it be through sort of style factor approaches, through sector investing considerations, and what some of the trade-offs and opportunities might be, again, from using passive in the context of implementing active strategies. So I sort of just want to be clear about what the benefits might be and how you think about indexing in building portfolios. I think a lot of times people talk about indexing as being lower risk. Actually, in many ways, nothing could be farther from the truth. Because while there may be less specific manager risk in an indexed approach, using passive products to implement an active view may not lower, and in fact may even increase certain total portfolio risk metrics, like, for example, tracking error relative to the broad equity market. So it's a way that we argue you can actually better target the risk exposures that you want with greater diversification, with greater control over the exposure that you want to have, and with often greater style consistency in that segment that you're trying to target. And so that, to us, is where the indexing or passive approach can potentially add quite a lot of value in allowing you to express the view that you want to. Instead of, if you think of traditional active stock selection or bond selection, you may have a certain factor exposure with a traditional active manager, but you're going to have a lot of noise around that factor exposure. There might be different views of what an attractive security is within a particular market segment, and that could lead to factor risk differences that may not necessarily have been what you were trying to target in, for example, you wanted to target small caps, but somebody's definition of small cap might have included something that is not in sort of the segment that you were trying to target. So that's where these trade-offs come in, and how you might think about the implementation of index in those ideas in terms of portfolio construction. The other thing that we see as this whole debate about index and active has been taking place, and this, as I've said, the evolution of this discussion, is a lot of times this gets couched as ETF versus mutual fund. ETFs have certain advantages, or mutual funds have certain advantages. I think a lot of times this discussion, much like the Robin Thicke pop song Blurred Lines, has kind of blurred the lines of exactly what is it we're talking about. Are we talking about ETF and mutual fund, or are we talking about index and active? And I think when you think about the traditional definitions of index and active, index being a passive implementation seeking to track a particular index, versus active being a desire to outperform or maybe to have lower risk using techniques to select securities that give you a different outcome than, say, a broad benchmark that you might otherwise track through an index approach. But when you look at the index versus active cut as opposed to ETF fund, you see that really the similarities between ETFs and mutual funds are really along that dimension of index and active. Index ETFs and index mutual funds look very similar from a cost standpoint and from a portfolio turnover standpoint, and that's what's reflected here on this slide. So the ETF and the mutual fund in many ways is a structure. It is a wrapper to provide exposure to a particular investment approach. And some people may be surprised at the cost. Every time we show this, it's like, wait, but ETFs are cheaper than mutual funds. That's just well known. But that's kind of the point, which is that the mix is different between traditional mutual funds and ETFs. Traditional mutual funds are about 85% or slightly more actively managed, whereas greater than 95% of ETF assets are classified as indexed. But when you strip away that distinction of ETF fund and instead present it from an index active, you can see how similar these vehicles really are. And so they're providing somewhat of the same type of exposure regardless of the vehicle. I will say, though, that from an implementation of active approaches, many people may find ETFs to be more convenient simply because, especially as you be more active, more short-term positions, because a lot of times there can be portfolio impacts on large transactions or short-term investors in traditional mutual fund portfolios that are in many ways insulated with the ETF structure. So from that standpoint, a lot of times providers of index products actually will prefer that shorter term or even long-term strategic, where there might be big block movements to and from a portfolio, be done actually in the ETF format, just from that ease of portfolio management standpoint. So the other way that there has been a big evolution that ETFs in many ways have brought to the marketplace is in this concept of better indexes. One of the things that has happened over the course of the last decade, without a doubt, has just been this explosion in new index creation, different methodologies, different providers, different ideas, different market segments. How do you think about building portfolios and then implementing them through an index and ultimately coming to market in an ETF vehicle? ETFs, unlike traditional funds, do have a much wider array of benchmarks and strategies tied to them in that passive form. And this really is another way that the worlds have collided. And really blurred lines, because in many cases a lot of better, quote-unquote, better indexes are seeking to outperform the broad market benchmarks that might occur. And so many of these approaches, and we've at Vanguard have written some white papers on this topic, often will reflect certain systematic biases. So, for example, is it the weighting methodology that adds the value, or is it a systematic exposure to, say, smaller cap and value-oriented securities that provides risk differences that may pay off over time or may underperform depending on the market cycle? So, and in many ways, a lot of the approaches that have come to market are really extensions of what had been active quantitative strategies in the institutional marketplace over the course of the last 20 years, but have been in many ways converted or adapted to implementation through an index representation. So I think in many ways we have this blurring of lines between index and active, where there might be an active strategy but applied in an index sort of way. And I want to say, because I think oftentimes this discussion of index and active has become much, much too black or white. You know, it's like you're either, if you say that you're against indexing, then you're for active, and if you're against active, then you must just be an indexer all the time. And really, that's not the debate that we really think is useful. The way that we talk about this index-active discussion is that, you know, and Vanguard's well known for espousing market cap weighting as an index philosophy or approach. And I think too often it is viewed as a somehow pejorative statement on active management. And actually nothing could be farther from the truth. It's a discussion of terminology more than it is a good or bad. Simply market cap weighting.
Joel, can I chime in really quick? I just want to, I don't want to distract you too much, but you guys are on the record saying that the only beta is cap weighting, and then when you start getting into other nomenclature, whether it's smart beta or intelligent beta, that's something else. If you guys disagree with the current nomenclature, what is it? I mean, how do you characterize it in terms of just a way that people get their heads around it?
So there is no doubt that the non-market cap weighting approaches are being applied through seeking to track an index in many cases. That is a definition, if you will, of index fund. But the underlying methodology may in fact reflect active bets or active choices that are being made. Ultimately, what market cap weighting represents are market clearing prices. That is, they reflect the prices that have been determined through voluntary exchange of buyers and sellers in the marketplace. So if you have a different weighting methodology, you are saying in some way, and it depends on the particular index that's being constructed in a non-market cap weighted way, you're saying in some way that the market clearing prices are wrong. And that's fine, but that is exactly what an active view is. It's saying, I believe that the market has systematically mispriced a security or a group of securities that have certain characteristics. And whether that's implemented in indexed form or not, that is in many ways an active choice to overweight those securities or those characteristics relative to the market clearing prices that have been determined through voluntary exchange of buyers and sellers of shares of the underlying securities. So that's why I say it's not meant to be a pejorative distinction at all. It is meant to just say, let's call what it is, which is that in a particular approach of alternative weighting or so forth, that you have that view that there's a different systematic approach to security selection. In fact, one of the things that has occurred, and this is a paper that we wrote called Joined at the Hip, is that there has been a little bit of a bias in index construction that has been brought to market. And this has very significant implications for due diligence and thinking about new indexes. And I think a lot of times people are thinking of index in the form of an objective, unbiased representation of a market or a market segment. But what we have found, and what this chart really shows, is that new indexes that are being brought to market tend to be skewed towards strategies that have performed well in the recent past. So this chart, for example, does what's loosely called an event study that looks at when an index goes live, and a lot of indexes have back-tested data that index providers might have available on their website and so forth, with the idea of trying to give a sense of how it might perform in different market environments or how it would have performed historically. And the indexes that have come to market tend to be very skewed towards those strategies that have performed well, and you can see that in the sort of left-hand side of the chart, where indexes coming to market have outperformed, say, the broad U.S. stock market on average of about 12 percentage points a year. But then after the live date, they have sort of market-like or slightly less than market-like performance. So, it's the old adage of past performance does not indicate future results. That's especially true with hypothetical data. So the point being that just because it's called an index may still mean that it's been fitted to the historical experience. So just like you would have some sort of skepticism and do additional due diligence on a sort of a traditional actively managed approach that would come to market and say, hey, well, if we would have followed this in the past, it would have performed like this, and show you some sort of back-tested information. Some of that same sort of skepticism or additional level of due diligence needs to be applied to the index construction methodology as well, because it may be that the index is not as objective or unbiased as you might think. It's just that you're being presented with an index that happens to have performed well recently. With that, I'll turn it over to Jim to talk about how this implementation of active with passive could work in a couple of different examples and some of the trade-offs.
Joel, can I ask one question before Jim jumps in? Is what you just said essentially an indictment in a general sense of back testing, or is it a little more nuanced than that?
I think it's a little more nuanced than that. I mean, it's at the end of the day, just like any due diligence process, you need to understand what you own and what has driven sort of the returns that underlie it. So, for example, if there are 300, just hypothetically, if there are 300 different indexes that come to the marketplace, all with different names and different approaches and so forth, but they all tilt towards, say, value stocks, after a period when value stocks outperformed growth stocks, then all of these strategies might look attractive, but it's really a factor exposure as opposed to these 300 different index construction methodologies that you're seeing. So it's just a matter of understanding what's driving those returns and being careful in that due diligence process.
Thanks.
All right, so as Joel mentioned, I mean, we want to talk a little bit about some of these, implementation strategies with respect to ETFs. And I know Joel gets this as well, and I do when out on the road. Invariably, we get that question, okay, ETFs, I see what I want to use them for, but how do I use them? And in what situations? And he and I talk about this, and, we maybe crack a little bit of a smile and say, well, for just about every reason you would use a mutual fund, you can use an ETF too. Whether you want to set up your asset allocation or you want to implement a sub-asset allocation strategy for those who are more tactical and they're doing market rotation, you can use conventional mutual funds just the same as you can ETFs. On an individual level, you would say, really, what can I do differently with ETFs? For those that need intraday cash equitization, or perhaps you don't want to own a conventional mutual fund that may have short-term holding restrictions, then obviously you would actually need an ETF for that. Or perhaps from a risk management, hedging, or shorting perspective, you're able to do those with ETFs. But, largely speaking, for the most part, whatever you can do with a mutual fund, you can do with an ETF. Now, to Joel's point earlier, if these are some of the individual uses, it still lends itself to this broader picture of when you are using ETFs, your tools might be passive, but your overall strategy might not necessarily be passive. And we can take a look at that with, with this picture. We all know what it's like to build a portfolio, and I'll just stick with the 9-box, for example. For investors who use traditional active management, you do a lot of due diligence and a lot of research, and you try and find your preferred active manager, and you fill out all the 9 style boxes. And, as we look at this graph on the left, mentally, we categorize all 9 of these managers as if they neatly fit into an individual box. But we know from the right-hand side, and the way that active management works, they all don't fit neatly into a box. And to go back to Joel's phrase, this is not a pejorative. This is nothing negative or bad about active management. It's just the case of when trying to beat a benchmark, you need to weight your securities differently, or perhaps go outside of your benchmark to beat your benchmark. So you end up with this case of this jigsaw puzzle that doesn't quite fit. So the first strategy or implementation with an index fund might be the baby step. Start with one. If you're using this 9-box of active managers, use one total market or one broad market ETF to sort of blanket where you might have these exposures and perhaps mitigate the overlaps. And in terms of dialing how active the overall strategy is, it now becomes a very simple, you have a certain percentage of your portfolio in the total market index fund and a certain percentage that is the amalgamation of the active funds. And to the extent you use a greater share of the total market index fund, in that case your overall strategy becomes more indexed. The less you use of the total market index fund, then the more active the overall strategy becomes. Perhaps the more advanced level or the next step would be, suppose you're using a couple managers in the 9-box, but you're not using one for all 9. But you still want to make sure you have broad-based exposure to the full 9-box. So you may or may not choose to own that total market index fund, but rather you might pick the index fund equivalents in each of those different 9 boxes. And, getting back to this passive tools but active strategy, now the strategy becomes a little more detailed in that now you have allocation decisions, sub-asset allocation decisions, by having different weightings within the 9-box, and the choice as to whether or not you're using an active fund or an index fund. So in the cases that the overall weighting is not the same as the broad market capitalization weighted index, that's sort of one level of active risk. And the choice to therefore use an active manager within any one of those buckets is an additional layer of active risk. So here, instead of just using the 9 active managers and the one broad market index, you might have some combination of active managers alongside combinations of index funds. But again, just because you're using individual index products still does not necessarily save you from having avoided what can be an overarchingly active strategy for this portfolio. So maybe the most sort of advanced active strategy, if you will, is the one where we work with advisors frequently, and their total portfolio consists of ETFs. And this gets to the heart of Joel's earlier message about passive tools, active strategy. And some of the most well-known active strategies are those investors who are attempting to outperform the broader market with respect to factor tilting. Right, for those who may believe in the small cap premium or the value premium, or together, the small and value premium. So what the slide here we're going to take a look at emphasizes why you would use index funds, or why you would prefer to use index funds to implement the factor tilting strategy. And it's first and foremost an argument of control. Right, the idea is you are seeking to outperform on the basis of the factor. In other words, you're not trying to outperform on the basis of security selection. So what's important to you is capturing, if I'm a believer, for instance, in the small cap premium, I want to capture as purely as possible the amount of the small cap that I'm attempting to obtain. So the returns-based style map here on the graph is showing what's the outcome of using different combinations of index funds on a style mapped basis. And if you can look at sort of the top line near the middle, that's the style map for a portfolio that is purely based on the Russell 3000 index. So this investor owns the total market as defined by Russell. And if you just go straight vertically down the picture, what we've done here is introduce 20% increments to the Russell 2000. So an investor who starts out 100% Russell 3000 index, they become an 80-20, 60-40, 40-60, 20-80, until they're finally a 0-100, meaning a fully Russell 2000 index investor. And there are different ways of capturing different premium. We do the same thing moving horizontally across the top, except in this case the tilt, if you will, that we're adding to the broad market is the value premium. Right, so adding to the Russell 3000, we put in 20% increments of the Russell 3000 value. So moving from the middle to the left, we go 80-20, 60-40, et cetera, till you reach the very end and you are a fully 100% Russell 3000 value investor. And then finally, quickly, the diagonal down to the left is the same concept, but the tilt is with the Russell 2000 value. So I think what you see from this returns-based style map is using the combinations of market cap weighted indexes. Whatever your preference is for the factor tilt, we see that each of these dots, which is a 36-month period, and the combinations have been rebalanced annually, I think we clearly see for any given combination, the clusters sit fairly tightly upon each other, and they're pretty well evenly spaced out no matter what direction you go in. So again, from an investor whose strategy is predicated on outperforming by capturing whatever premium it is as purely as possible, combinations of market cap weighted indexes give you the most control to do that. Now obviously the other sort of set of dots that stick out on this page is using one of the more well-known alternatively weighted indexes in the marketplace. And again, to make it clear, what we're talking about here is the emphasis of control. Now we know from the research that alternatively weighted strategies, as Joel has mentioned, have gotten their performance from usually some dynamic combination of small and or value premium. But as you can see over time, sort of the amount of small or value has varied. There are some instances here or some time periods where there is a extreme value tilt. There's others where the tilt is a little bit more mid-cappy in nature, but as you can see, there are some periods where it gets much closer to blend and much closer to large cap. So again, the emphasis here is not on whether or not that makes any other constructed index bad or good. The overarching benefit here for using the combinations of traditional market cap weighted indexes is for investors who are seeking total control of that premium they seek in their search for outperformance. Now the next question naturally becomes, okay, that's interesting, but what if I were to implement that tilt using active management? And here we almost have this paradox, if you will, that the conventional wisdom might say, well, I'm going to tilt towards a specific factor or tilt towards a premium, and I'm going to use an active manager to even do better than that. Well, what ends up happening is, as I mentioned, because active managers in their quest for outperformance either reweight securities in their indexes differently, or perhaps they get securities that are outside of their index in their quest for outperformance, they end up changing the factor exposures of their particular portfolio strategy, which means as an investor, if you are, again, seeking the control, you're seeking total control of those factors, you're not outsourcing, or you're not looking for security selection, you are looking to get control of those factors, the use of active management for the tilt actually dilutes your control. And this heat matrix here we think helps to illustrate this. What we've got here is a group of small cap value active managers who are grouped by quartile according to their active share. And very quickly, active share is a measurement of basically how active your portfolio is. Quartile 1 represents the highest active share, meaning those small cap value managers whose holdings were most differentiated from the index, all the way down to quartile 4, which was the lowest active share, and the bottom row being a combination of traditional index funds, which you would say are little to zero active share. Now what you can see by the heat matrix is, and going back to, again, our message that just because they're passive products, it's still an active strategy. If you go left to right on this chart, and as you turn the dial, so to speak, of being Russell 3000 and adding some increment of Russell 2000 value active managers, right? So we go 0-100, which is the all Russell 3000 index combination, and you go left to right. You will see that these measures, which is the tracking error versus the broad market versus the Russell 3000, you will see that tracking error goes up. Even in the case of the bottom row, right? So this is a pure strategy that uses passive products. So if I use a Russell 3000 index fund with a Russell 2000 value index fund, you still see that your tracking error versus the broad market goes up because you're becoming more differentiated from the broad market. But oddly enough now, what you see, again, your search for outperformance is predicated on control. You see that as the active share in the actively managed fund gets higher, oddly enough, your tracking error versus the broad market gets lower. And that's because as managers reweight their securities or go out of benchmark, in this case the Russell 2000 value, they go out of benchmark to get their exposures, you as the portfolio constructor you are losing the factor exposure. You're losing the total control. So you now have this notion of you're seeking control of the factor tilt, but by implementing active management in the tilt and a higher active share manager in the tilt, you actually end up losing that control of the tilt that you are seeking. So we can change our view here from the style box maybe to more of a sector approach as another way of implementing this strategy. And I think we've all sort of put a much bigger focus on index construction over the past couple of years as the advent of ETFs have become so popular. And we've seen over the past decade that the major index providers, where they had vast differences maybe a decade ago, have become increasingly more similar. They've started to adopt each other's best practices, but they still do have definitional differences in terms of how they define their total market, or even more particular, how they carve up that individual market. And, quite simply, the graphic on the page just shows different index providers and, the extent to which they cover and or define a market. But as we get into this specific example I'm going to use about sector exposure, and in particular healthcare exposure, what we're going to see is that in many ways, investors, we use the phrase all the time, look under the hood. I sometimes use the analogy of there's an iceberg at sea. Right? The iceberg is floating around, and what do we see above sea level? We see the tagline healthcare index or healthcare fund or healthcare ETF, because that's what's visible to everybody. But what I'm going to touch on here is what are those other factors below the water level that have an impact on how the healthcare part performs, or other factors that may dilute just how the healthcare component does or does not perform. And those include sort of the size, the capitalization factor. It includes your stock or your idiosyncratic impacts, as well as your subsector, right? So even though it's healthcare, how might differences in pharma and or biotech influence that as well? So, really quickly, we can take a look at what the stock-specific differences might be. If you take a truly broad market, total market approach to looking at the sector universe, you would see you're pushing well over 3,000 stocks in a total market. And then with a couple of the examples here on the page of different ETF providers' sector offerings, you can see there are differences where there are some that are far more concentrated in stock names because they are more predominantly breaking their sectors into large cap components of various sectors, and with other providers on there that might have a more broader market view, or in some cases a total market view. So the first thing we think about is, just because we see the tagline sector, investors need to ask themselves, are they getting the total factor experience, if you will, the total market of healthcare, or are they getting more concentrated in maybe just the larger size of healthcare, which means fewer names, and perhaps the performance is being driven at a more idiosyncratic level and not as much based upon the factor, or in this case, the healthcare level. And a way to illustrate that with the capitalization range is in this table here. You can easily see what the features of a total healthcare market might look like with respect to, say, median market cap, weighted average market cap, and the minimum market cap. All right, so the weighted average being about $79 billion with the minimum down to 5. And you contrast that versus some of the other ETF providers in the healthcare space, you get widely diverging experiences where there are some, such as the Spider series, and again, not to use any pejoratives, but from a healthcare strategy that is predominantly a large cap, investors can end up having a very different experience than choosing healthcare exposure that might be more on an all-cap basis, where you get healthcare not just in the large cap sector, but all cap through mid caps and small caps as well. And if I talk about this, this iceberg where we, highlighted, well, there's sort of concentration or idiosyncratic risk, there's capitalization spectrum risk, well, there could also be subsector risk, right? So for investors who are seeking healthcare, all these different factors can shape how their healthcare performs. Another way that can impact the performance is, what about the subsectors in healthcare? Because they too, although they would arguably be highly correlated with each other because they are in healthcare, they still end up having differences. And I'll take this a step further, that beware that if you're an investor who even specifically wanted pharma or biotech, then clearly you just wouldn't want a broad-based healthcare. You would want something specific to those subsectors. But again, when you take a look at what is the total market exposure, and we use the Dow Jones U.S. total stock healthcare as just sort of the proxy for the total market for healthcare, and you gauge that versus some of the other products on the page here, investors can have a vastly different experience because, again, we see the label healthcare above sea level, if you will, but below that watermark, depending upon what other factors are there, the idiosyncratic risk, the cap spectrum risk, or the subsector risk, again, these end up being drivers of variation in performance, even though the label just simply says healthcare.
So, where this comes into play often is, and I go back to sort of the due diligence and what are you trying to target in your active strategy. And at least over roughly the last 10 years as shown on this chart, one of the things that you can see in this is just obviously an example around healthcare, but it's a more general one that can be applied in different, whether it was factors that Jim first talked about or sectors, talked about now, or in other sort of the tilts that you want to have in a portfolio. The narrower approach, at least over this period, had less ups and downs. That is, in essence, it had a somewhat lower healthcare factor beta, if you will, than broader portfolios. Now, that may not necessarily hold from period to period because, again, that gets into, all right, were these ups and downs due to broader healthcare exposure, or was it due to a small cap, large cap factor distinction? So, again, the point just being that what having the control through the use of ETFs and passive products to be able to target the risk exposure that you want in that active view can be very powerful and potentially more achievable in that format when it's a factor, a sector, a market segment that is being targeted with that view. If it is the skill of a particular manager that you have a lot of confidence in, then that traditional stock selection approach will still hold in terms of how you want to target it. But the discussion of active and passive in many ways, as we've talked about, has been blurred by the use of ETFs, how people are using them, and what views are being expressed. And so we just sort of wanted to conclude this part of it, and seeing some questions come in that I'm sure Ollie will give to us around this concept of how passive products can actually be quite useful, quite powerful in implementing active views because, and especially in a market cap weighted standpoint, you're getting that exposure where the indexes can provide control and style consistency to provide the targeting that you want with those approaches. So those intended exposures are more easily, at least arguably, more easily matched through the use of certain passive products. And oftentimes when you think about implementing this, it does require sort of the thought about what exposure am I trying to provide and how do I best do that? Do I need a broader approach? Do I need a narrower approach? And that sort of comes down to sort of the view that you're trying to express. But at the end of the day, whether you're using passive products to tilt away from, say, a broad market view, or you're using traditional active management, it's still active. That is, you're making an active choice and taking on active risk in doing so. And that's really, in many ways, what the revolution of ETFs, if you will, one of the things that it has brought is this redefinition and evolution of active and different approaches to active management. And really, in many ways, we're in the beginning stages of that continued, ongoing, and really growing discussion of how to use ETFs in many different portfolio construction uses, obviously, to be able to express either a long-term strategic or tactical active approach being one of those key ones. With that, Ollie, I'll turn it back over to you, and how do you want to go about the rest of the webinar?
Well, we do have some questions coming in. I want to remind all the attendees that if you want to ask a question, you would enter it in the lower right of your screen, so keep them coming if you have questions. I just wanted to do like a 30,000-foot perspective question just to kick it off here. Is Vanguard going to be advocating this approach more systematically? I asked that mindful that you're known as an index shop. You have also a reputable active shop. And here this is certainly active as well, but a whole new way of skinning this cat. I mean, are we going to see something like Vanguarding be carted out here in the coming years, only it'll be the power of active and passive or something like that? I mean, how committed are you as a fund company?
I think the way I'd say what we are committed to is making sure that investors see both sides of this coin, or the other tagline, there's no free lunch. Our message here is going back to what we said very early on in the call, is that just because you're using passive tools, it doesn't mean your strategy is. And whether we're talking sector exposure or we're talking combinations of market cap weighted indexes, what we would advocate for is that if that is your choice as an investor, all right, that is your choice to seek out performance due to overweighting sectors or tilting somewhere in the style box, just please understand what the risks are you are taking and that this is an active strategy that you're undertaking.
I'm just going to add in that, a lot of times, we're not. I mean, Ollie, we're not going to say at Vanguard, buy Malaysia, sell Indonesia. That's not what we're talking about here. But what we are saying is that if you as an advisor, as an investor, you have a long-term or even potentially short-term, but a view on a particular area of the market, you need to make that choice or that distinction between, is this a factor or a sector exposure where I'm just trying to get that exposure, or am I betting, if you will, that a particular talented security selection manager is going to provide the alpha that I want? It's what's the source of alpha, how do you distribute it? And if it is the case that a passive implementation of that view might work. So for example, if you have a view just as a strategic overweight to small cap value as a tilt, great. That can actually be implemented in low-cost passive vehicles, which are now much more prevalent with the growth and development of ETFs, and that may be the way that you want to implement that strategic overweight. So, we'll definitely be talking more about this because it's about portfolio construction and implementation of what you as an investor and advisor want to do in your portfolios and how you might best achieve that given the tools that are available.
Got it. Thank you. Now, I have a question from the audience here. I think it's sort of an elementary question, but one that matters. Has to do with this thorny semantical issue that I touched on very briefly earlier. The question is, I've heard the terms smart beta and factor tilting as if they were different, but they do seem similar. Are they different, and if so, how?
So this is one where whether we call it alternative weighting, whether we call it smart beta, whether we call it alternative beta, I mean, there are any number of names for basically what has come to be non-market cap weighted approaches that are in many ways geared or marketed towards saying we think you can do better, that we can provide alpha through index construction. The way that we at least think about that is it is more about re-weighting factor exposures than it is about some sort of smart beta, or all of a sudden we figured out how to outperform benchmarks when the average manager hasn't been able to do it for the last 40 years. I mean, if it were so easy to just outperform through re-weighting the same securities, that would have been done a long time ago. What we think it masks is, in fact, that it is factor investing that is the is what you're getting through these different alternative beta, alternative weighting approaches. And in fact, I actually wrote a blog on this that tried to describe it a little bit more carefully this summer that was called Solid, Liquid, or Gas. And it basically made this analogy to my daughter's middle school science class, where you think about water, and water can take different forms: ice, liquid water, or water vapor. And what's different about it is just simply that the temperature that is applied to the water, but regardless of whether it's ice, water vapor, or liquid water, it's all the same molecules. It's all H2O. Similarly, you can take the same set of stocks, say the S&P 500, and market cap weight them or equally weight them, and you've changed the form, if you will. Much like water or ice, now you have overweighted sort of the mid-cap or smaller cap names within the S&P 500. So is it still an S&P 500 portfolio? Yes, it has the S&P 500 securities, but we would argue that the factor risk exposures have been altered through that reweighting. And so a lot of times this whole smart beta discussion is glossing over what is in fact materially different factor exposures when compared to a broad market cap weighted approach, where too often that's what it's being compared to, and not the discussion of, in fact, that the source of any performance differences might just be from a reweighting of the factors.
And maybe I'll just add to that is, it might be semantics of definitions, but when we think about what that factor risk means is, right, these combinations are factor tilting, to the extent going forward, if it were to happen. The same thing happens what we've seen for 80 years, right? We have seen, factually, value has beaten growth, small has beaten large, from an excess return standpoint, right? Just value minus growth has equaled outperformance. That's not really the same as alpha, right? Alpha is a risk-adjusted measure of outperformance. And what these tilting and other strategies have proven to be the case, once you account for the value premium and when you account for the small premium, the alpha or the risk-adjusted outperformance goes away. There may be still excess return, just simple A minus B, but there's no risk-adjusted outperformance. And that's why it's very important to focus on these factor risks, because it's the factor risks that have been the sources of premium. And again, that's led to excess return, but not risk-adjusted outperformance.
Got it. Now, there's some questions coming in about factors themselves. This is a very vibrant area of academic research in the realm of portfolio management. Certainly, it would appear that the world has come a long way from the fameux and French insights of the early 1990s with regards to value and small cap, which, Jim, you touched on in detailed manner a moment ago. To the extent that there are new things coming into focus, whether it's momentum or quality. Are there some factors that make more sense to you that are quote-unquote legitimate in Vanguard's ETF, Vanguard's estimation? And we have a very specific follow-up there, too. I'm going to put it in there because we're getting close to the end of our Q&A here, and I want to make sure that important ideas are on the table. With regards to your product lineup, is there product development that's going to have to occur for you guys to truly exploit this realm of factor-based investments? And specifically, there was a question that came in: how do you obtain the quality factor using Vanguard ETFs? There's I think 3 questions embedded in there, but you can unpack them at your leisure.
So, there are a number of issues there, and product development. By the way, a lot of the sort of common factors that people think about are already available, whether it be through Vanguard or other places, like small cap and value, like corporate overweights on the fixed income side or high yield or so forth. So a lot of that, the sort of the main big broad-based factor exposures are already covered even at Vanguard. There may, in fact, be some product development. I mean, certainly this factor-based approach is one that has been increasingly discussed, Ali, as you mentioned. And in fact, today, I mean, we did launch on the traditional mutual fund side a minimum volatility portfolio.
I'm glad you brought that up.
Yeah.
Is that value in disguise? Was another question, as long as we're getting into how these things mix up a little bit.
Yeah, I mean, so a min-vol portfolio, and it's interesting. I mean, first of all, it is actively managed, and we're calling it actively managed. But it's interesting because its objective is to seek to provide exposure to global equities, but with lower volatility. Notice it's not the traditional active management approach of seek to outperform a global equity benchmark. So it's very much an exposure for those investors that at least want to attempt to try to get exposure to global equities, but with maybe a little bit of a smoother ride if the fund is able to meet its objective. And it takes a portfolio view of building a more low vol or min vol portfolio. So this is just one factor, and in many ways it tends to overlap with does it have some sort of value exposure to it? Yeah, probably. And if you do a style map like Jim showed, in many ways it's taking what has been identified often as a at least historical risk-adjusted difference in beta. Low beta stocks have done a little bit better than you would have expected just simply from a beta standpoint. Now, we don't necessarily think that'll hold going forward, but there are theoretical, at least justifications for explaining some of the historical data. Things like limits to arbitrage, like behavioral issues on the part of investors that can do that. Now, what I would say in terms of general factor exposure is that's one where, in many ways, investors kind of have to make their own distinction and qualification of what they think is a long-term enduring factor approach and whether it will work for their type of portfolio, for the objectives that they have in building their overall portfolio. So that's where you may see some more product development from Vanguard from a factor standpoint. As some of these different factors are further discussed and so forth. But there's nothing on the plate in the immediate future.
Quick question. We're really running right up to the end of it. Active management in the traditional sense, the stock pickers, it's been associated with high portfolio turnover, relatively high transaction costs. Can you comment in a general sense how this top-down approach might minimize that, particularly with relatively inexpensive products?
Yeah, I think from what Joel showed some stats before that we know that roughly speaking, actively managed strategies have higher portfolio turnover, and higher portfolio turnover leads to higher transaction costs and/or typically, higher capital gains distributions. So those are two parts of your return that get eaten away, if you will. And the other one is active management tends to have higher expense ratios than index products. So when you think about as an investor, there's two parts here. Number one, there's the cost, right? Higher cost, higher is your hurdle to whatever goal it is you're achieving. And generally speaking, active management has higher expense ratios and higher portfolio turnover. The second part we talked about here was this is about the control factor, right? This was not saying active management can or cannot outperform a benchmark. That's not the message here we're trying to convey. It is from an investor who he or herself believes can outperform based upon capturing purely the factors. Combinations of index funds are the best way to capture the factor exposure and do so at a lower cost.
Okay, great. I think that is about it. We're running up right against the top of the hour. We did start a minute late, but we're going to call it a day. That concludes our webinar, The Power of Active and Passive. Joel and Jim, thanks for being my guests. And I also want to thank the audience for attending and for asking some thoughtful questions. As I said at the outset as well, the presentation will be available to all of you within 24 to 48 hours. You should receive an email detailing how to obtain it. On that note, on behalf of my guests from Vanguard and all of my colleagues here at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.